afternoon, ladies and gentlemen. Welcome to our special show, Market Masters, where we get you to meet the best wealth creators that are there on Dalal Street, people who are supremely intelligent and have navigated the ups and downs of markets for decades. I am Shail Bhatnagar, and it's with me my colleague Sakshi Batra, and we are very honored to welcome our friend Mr. Sanjay Sinha. He is the founder of Citrus Advisors and has been in the market since 1989. A brilliant man who's worked with 3 asset management companies such as UTI Mutual Fund, SBI Mutual Fund, and of course L&T Mutual Funds. Over the last dozen years, he's gone entrepreneurial and is the founder of Citrus Advisors. A very warm welcome to you, Mr. Sinha, and what a pleasure to host you at a time when a wonderful bull market is unfolding on Dalal Street. How have you been?
Thank you so much for those kind words, and thank you for the very warm welcome. Yes, I absolutely agree that the bull market is exciting for most investors, but at the same time, let me tell you, the bull market is one of the toughest market for a fund manager, because
Yes.
he has to invest in a rising market, and
Yes.
fund managers are always comfortable to invest when the valuations are low.
Yes.
Bull market, unfortunately, do not give you that luxury. You have to invest anticipating growth in future, in which perspective the present valuations of a company in which you're wanting to put in money may not look very attractive. So,
Okay.
so it is, bull markets are always tough for a fund manager.
You know, Sanjay ji, that's why Sakshi and I have always chosen the easy way out. We ask sensible questions and we get intelligent experts such as you to solve this problem that is often afflicting everybody of us, that there is always this crisis of feeling of missing out in this bull market. The stocks that you buy don't move, and those that you missed are the ones that rise 20% each day. I am sure you also undergo similar feelings.
Yes, so that's actually quite common, more so because people take some time to first believe that a bull market is actually taking shape, and within the bull market, if they hear about certain stocks, then there is an initial period of skepticism, then suspicion, and then maybe some gradual acceptance that yes, this stock does look attractive, by which time probably the stock may have run its full course, and that's why a very common experience that people have, that they buy stocks, and after they have bought, the stock stop moving, and the
Yes.
stocks which they haven't bought are the ones which are moving.
Okay. So, Sanjay ji, we are fortunate to have you on the starting of the week, and over the weekend a lot of developments have happened. Amongst the most important ones is the manifesto that the ruling BJP has released, keeping in mind the 100-day plan and the next 5-year economic plan that it has in mind for Asia's second largest economy. You've gone through that manifesto with fine tooth comb. Tell us the 2 or 3 points that you liked, and how are they going to impact the markets?
So I would say that first and foremost, the manifesto is normally a political statement, and therefore it largely caters to what people want to hear than actually what the government wants to do. You will find that there are promises which are made in the manifesto which are not always implemented. But in the context of the manifesto that came out over the weekend, I will say that there has been a fair amount of stress that has been given to a long-term perspective plan to take India from the current state that we are to being a developed economy by 2047. So, which means that you have set your aspirations very clearly before the population, which means that in the process you have to some extent tried to prepare people that there could be some discomfort in the short term, but in the medium to long term we will actually be able to look forward to a better life. So I would say overarching, this is one message that has come out from the manifesto. More specifically, the manifesto is also talking about a few specific marquee economic projects which can be seen to be maybe the signature of the current dispensation. One of them in particular is the bullet train project, which till now was seen to be only confined to the western part of the country, the train which is supposed to run between Mumbai and Ahmedabad. But in the manifesto, there is a talk about starting three similar projects in other parts of the country. So that is one. The other part, which is somewhat related to this, is the focus on logistics and mobility, which is where the government is talking about Vande Bharat trains in three formats and starting corridors in various parts of the country. So that is the other part that I see that is being stressed upon in this manifesto. But at the same time, the manifesto will choose to be quiet about some of the more aggressive reform processes, which may be politically not so comfortable. Like, for example, the privatization of some of the banking entities, which was discussed during the second term of the last of the government, but nothing much came out of that. I'm quite sure that given the political implications of such an announcement in a manifesto might be counterproductive, they may have shied away from such an announcement. But I will not be surprised that if there is a sufficiently good mandate that they come with, this could be one thing that could be pursued by the government, even though not stated in the manifesto. So therefore, in summary, if I have to conclude, I will say that one important aspect about this manifesto is the fact that the focus and the orientation of the manifesto is more
Right.
economic than political.
Okay, understood that. Over the weekend, sir, we've also seen geopolitical tensions rise. On basis that, we've got our first question from our viewer. From Noida, Shreyas Negi wants to know from you, with more countries going to war now, should I buy safe haven assets like gold?
So, maybe some of the motive for that question is also coming from the recent rally in gold that we have seen. And, we can ascribe different reasons for the surge in gold prices. One of them, apart from the geopolitical tension that we are now seeing sort of heightening in the Middle East, is the fact that in the past, whenever the Fed has cut rates, those phases have also coincided with the gold prices moving up. So the gold prices had gone up in the anticipation that Fed is now very soon going to cut rates, and the Fed chairman also confirmed that expectation. So part of the gold rally will be ascribed to that. Of course, the geopolitical tension, if it is going to heighten, gold could be a safe haven, but that may not be a haven from in which you can hide and protect all your other investments. So it can only be probably a hedge against inflation to some extent, but not completely.
Sanjay ji, are you comfortable with the kind of rallies that we are seeing in the markets these days? You have already mentioned about gold. Many commodities such as copper, aluminium, nickel are near record highs, if not at 2-year highs. And we have this excessive speculation happening in the crypto world. Bitcoin has reclaimed its previous peak and is in fact much higher. Are you comfortable with how equities are behaving at this level, or is it keeping you awake at night?
So, see, the rally in commodity prices is partly a function of the demand and supply scenario. And I guess it is also to some extent attributable to some of the, I will say, regulatory or political actions which have been taken. Like, for example, the more near-term rally that we have seen in aluminum prices has got to do with the fact that, effective from Friday, Russian metal is prohibited from delivery on the LME. Now, that is a self-invited, I will say, problem on our hands, when we already have a scenario that China's growth now seems to be again stepping up. So China as an engine of growth has always had a very profound impact on commodity prices. And if you see that scenario developing and you prohibit one major producing nation from coming to a major commodity exchange, you are actually compounding the problem rather than solving it. So over the last 2, 3 years, if you see the wide range of commodity, right from crude to other metals, I will say that some of the problems that have been created, which have led to increase in their prices, are not necessarily just the forces of demand and supply, but also some of these political actions which are making the problem more, I will say, unmanageable than it would have been under normal circumstances.
Okay. Sanjay, let's now look at Indian equities. Till very recently, we were at 22,800. Let's presume 23,000 is with us as far as the Nifty is concerned. And all sorts of indices, the realty index, the auto index, some parts of, pharma, small cap, mid cap, everything is afire. There is a massive broad-based rally happening on Dalal Street. Are you comfortable with such valuations, or are there pockets of froth that you are avoiding?
So, if you see the markets are characterized by two animals, the bull and the bear. So, very frankly, if you have an animal representative of a market, the spirits will also be very animal. So, in this sort of background, you will always find that it will not be an orderly movement of the market in either direction. In our particular case, Indian markets in particular, what has also happened is that, though belated, Indian retail investors have woken up to equity as a very attractive asset class. That is very, I will say, glaringly getting represented in the SIP numbers, which have kept on growing over the years. And what you see in the SIPs as an institutional number is also getting reflected in terms of the demat accounts that are getting opened. We now have close to 15 crore demat accounts, which are, 1.5 million, 15 million demat accounts which are operative in the country. And this number has actually increased quite substantially. Indian retail investors will warm up to the small and mid caps more easily than they would to large cap stocks, because these price movement in the small and mid caps are very, very, you can say, sharp. And therefore, that is something that excites investors, because they do not look at the value of what they are buying, they look at the price of what they are buying. In that sort of background, there is always a possibility of some froth being developed in the market. But having said that, if you go back to the entire history of the equity markets, there will never be a situation where all the stocks will be trading at their high or all the stocks will be trading at their lows. You will always have opportunities in every market. In this market also, while there is a froth in certain sections, you will have to look for opportunities, and these opportunities are presenting themselves. You very rightly actually hinted at the possibility of some opportunities in the market because of the cyclicality of the sectors which are now participating in the market. Look at, for example, the infrastructure stocks. For almost 10 years, there was no movement in the infrastructure stocks, and now all of them are moving in as a pack. Look at public sector banks. For so many years, they were nowhere among the contenders for the fund manager's attention. Now public sector banks are participating. IT, which was a darling of the market, is now so sort of ignored, and there is so much of apprehension around IT. So the cyclical nature of the sectoral participation in the market will keep on giving you opportunities, and therefore there is still a lot of merit in active management of money, where you need to keep moving money from maybe one sector to the other, or from one set of stocks to the other set of stocks.
Okay. Since you were talking about the PSU stocks, there's one question that I've received from Jyoti Shakaya from New Delhi. She wants to know from you, which are the sectors from the PSU pack that you still believe will continue to do better than others in FY25?
So two of them stand out very clearly. One of them is the power sector, because within power, not only do you have the largest player from the PSU pack, many of the sort of ancillary industries or industries which cater to power sector also are in the public sector. So that is one clear sector which I think could be an outperformer. The other sector which has been in the focus of the market for the last almost a year and a half or almost 2 years has been defense, because in that sector the government's increased focus on indigenization of production, and the fact that we now have started seeing a very strong growth in the order book of defense companies. Most of these active players in defense sector are again in the public sector. And if you permit me to add a third sector,
Absolutely.
I will say that public sector banks also, even though they have run up in the last few months, in my opinion, they continue to be relevant today, because if you look at them in terms of price to book value, some of them, somewhat, most of them actually are even now trading somewhere near their book value, or even now at a discount to book value if you take away the valuation of the subsidiaries in which they have investments. And therefore, going by the past history of public sector banks, I think there is still some steam left. So these three sectors, I would say very clearly within the PSU look promising.
Okay, wonderful. I hope, Jyoti, that answers your question very well. It was a very, concise, as well as three key sectors that are put out for you that will continue to do better. And I hope that you continue to make responsible investments in all of those too. Let's take the next question, sir, with you. The next one is coming from New Delhi. Hina wants to know from you, is it the right time to buy the new age tech stocks? Because Zomato and PB Fintech are now reporting profits. So should I start looking at them?
So, without getting pulled into a stock-specific discussion, I will say that these new age companies also have a particular cycle of their business. So, when they started, they were incurring heavy losses, but these heavy losses were to build a particular scale. And beyond a particular scale, they do become profitable. We can see that happening in the older and the larger global companies such as Alphabet, which is running Google, or Amazon, where they churn out billions of dollars worth of profits now, even though they were very heavy cash guzzlers in their past. Given the fact that, in India, we have such a large population base of, 140 crores, given the fact that, we have now such increased digital penetration, I'm quite sure you would be aware, my roots are in the villages of Bihar, and I'm, quite surprised. I was quite surprised when I visited my village to find that Amazon delivers to that village even today. So times have now changed. Given these realities, I think there is definitely a very fertile ground for these new age companies to build their businesses, provided they do so with a sensible eye on break even and profitability. Your viewer has mentioned two of them. I think as we go forward, there will be others also, and there are, in fact, today, even in the listed space, there is another entity which is a couple of entities, not just one, more than one entity, which is profitable, at least on, if not on a PAT basis, at least on the operating level. So therefore, surely this space, I think their time has come. When they got listed, it will be a little, they may have been a little ahead of time in terms of demonstrating profitability. But now more and more of these entities will show profits, and therefore you will be able to make your picks much easier now than when you did, when you probably invested in them on listing.
Okay. Let's take this discussion back to allocation of capital, Sanjay ji. It's almost a given that the present political dispensation will return with the majority somewhere in the middle of June. Given that background, how are you allocating fresh capital to Indian stocks? Do you think large caps are more attractive than mid caps and small caps? Or given this correction in the smaller shares, it's an opportunity to add them back to your existing portfolio? How are you placed in this divide between large caps and mid caps?
So, Shanidji, our first segmentation of the market is actually sectoral in nature. So what we do is, we split the market in terms of what are the attractive sectors that look promising in the current context. Then within these sectors, we go bottom up in terms of our stock picking. With obviously, if there is a large cap stock in that sector which is equally I would say equally attractive in terms of opportunity to a mid cap, obviously the leaning may be towards a large cap compared to mid cap. But there will be certain sectors in which the opportunity for a mid cap or a small cap would be phenomenally higher than the opportunity for a large cap. In which case, the risk-adjusted return that you can get by investing into that mid cap or a small cap would be more than compensating for the return potential of a large cap. Then you would choose to invest in that small cap or a mid cap stock. Therefore, so in today's context that you mentioned, which is that we will have policy continuity, and therefore there could be some you can say assumptions that you can make that there will be a thrust on infrastructure, there could be thrust on indigenous production, there could be thrust on developing entrepreneurs within the country. You would also like to see that there is consumption does not get dented too much, inflation will be brought under control. So with these sort of assumptions, the sectoral choices then become a little easier. And within those sectoral choices, if you have to start making stock picks, I would say that if you want to have a certain amount of balance between large caps and mid cap, a 60% allocation to large caps and a 40% allocation to mid and small caps together would be, in my opinion, be a healthy sort of mix to approach the market with.
Okay. Given the way this rally has unfolded over the last 8-10 months or so, Sanjay ji, there is hardly a point of complaint. We've seen a Goldilocks kind of a scenario unfold on Dalal Street. But two things that have caught my attention is the fact that two-wheeler sales are still below COVID highs, and the rural consumption, as all of us have tracked it via the FMCG basket, hasn't really enthused fund managers such as yours. Do you spend some time worrying about these, or will time also heal these ruptures?
No, so therefore, if the rural consumption does not pick up for too long, then it will surely be a source of concern, because, all things said and done, today, even though we have 60% of our GDP coming from the services sector, but if you look at the population which is residing in rural areas, that is an exact opposite. You have 60% of the population residing in rural areas, and therefore their source of income could be from other sectors. But rural income is definitely one of the key drivers for a lot of sales, at least in volume terms. I feel that this year there is a projection that the monsoon will be normal. I think that projection alone may not be enough. We need to have spatially well distributed monsoon, and in terms of time, it should not get too concentrated in a particular region in a particular time and lead to floods. So therefore, if the time and spatial distribution of monsoon is good, I think we can expect rural consumption to come back on track. Second thing is that election year is also a year in which you see a lot of cash moving to various parts of the country. A lot of activity happens around election campaigning, so and so forth. So all this can also to some extent fuel consumption. So I think it is very important that we get the rural consumption revived. I guess if it is not going to happen from these sources, then maybe some of the other things which have been done in the past and which in the manifesto also have been promised, like for example, the 6,000 rupees to every farmer every year. These sort of things will also supplement rural consumption. But yes, Shanidji, I absolutely agree with you that long term, rural consumption not picking up is not going to be very healthy overall for the economy or also for some sectors.
Okay, now let's take two more questions from our viewers. One is on the IT sector that you briefly mentioned. So Ravi Seth from Noida wants to know from you, what is your view on the IT sector, given that TCS has now reported good Q4 earnings?
So this earning actually has buoyed the, I will say, expectations of the sector, given the fact that the order wins have been very strong. And now analysts are talking about double-digit growth in FY26, if not FY25. So those thing I think are optimistic signs. Having said that, my view on the IT is that this is not a sector that you can ignore. This I say for two reasons. Just a short while back we were discussing consumption, and how is it that we look at FMCG stocks. So if you see the volume growth in FMCG, that's not very impressive, but they still trade at very expensive valuation. Compared to that, I think in the case of IT, the constant currency growth is probably comparable or a little better than FMCG, and they still do not trade at any valuations close to FMCG. Not only that, if you look at a little further outlook for the sector, the concern on the IT sector growth is more to do with the US economy's current state, and whether it was going to slip into recession, and or whether they are going to grow at a healthy pace. So if that outlook is also going to change, and given the fact that the world is now moving from the conventional IT uh, services to the more AI, digital, machine learning linked digital solutions. I think Indians have always played a very key role in all emerging trends within the IT. So why shouldn't they be participating in this? So I think that while we have near-term concerns on the IT, the longer-term outlook on the sector continues to be strong. And the best time to buy into a sector is when others are becoming apathetic, which is where people make money. You make money as a contrarian investor. So rushing headlong, but yes, you need to accumulate.
Okay, got that. So this was about the underperforming sector, and now the next question is about the outperforming sector. From New Delhi, Vinay Singhal wants to know what are the potential risks and opportunities for investors in the retail category for real sector in FY25, since it's outperformed in FY24.
So, couple of things which have happened positive for the real estate sector is it has become more professional. Second, it has become more transparent. And thirdly, it has become better regulated than what it was in the past. So I wanted to highlight these things because, there has been a situation when one of the real estate companies was actually the largest market cap of the market at one point of time, and from there it fell to nowhere. So given these three things which are in favor of the sector, what we have to look at is that does the macroeconomic outlook, and within the macroeconomic outlook, does the demand situation continue to be strong? I think the answer to both these questions are yes. The macroeconomic factors in support of real estate development looks very positive. And within, if you look at from the demand perspective, the demand for real estate at every level, whether that be for premium housing or at the lower end of the spectrum for the mass affordable housing, both look very good. So it is all a question of, where do you make your choices? And the fact that the execution capability of these companies over the last 2 years has been there for you to see and therefore make your judgment. I think, even in FY25, you will see real estate to be one of the key sectors participating in the market.
Okay. Sanjay ji, let me ask you the same question in a different format. Would you buy a flat at this moment, or would you buy a real estate stock?
Shailendra, I actually have been fortunate to have invested in a bungalow plot, and therefore, my demand for space has been fully satisfied.
Yes.
Okay. Having said that, on a more serious note, I and I think the answer to that is a little personal. I feel that people should invest in a real estate for satisfying a personal desire more than for the investment purpose, because uh, you actually buy a house because it is something that you want to call your home, and therefore you can customize it the way you want it. You will not be forced by your landlord to move after your lease expires. So I guess the decision to buy a home should be more personal. As far as investment is concerned, okay, now, in the capital market, you are getting multifold opportunities to invest in real estate. One is, of course, in real estate stocks, but look at real estate investment trusts. Earlier, we used to have one, now we have so many of them. Very soon, you will also have real estate mutual funds. So therefore, for the investment purpose, I would say stick to the financialized form of real estate rather than the actual investment in a illiquid, high value investment option such as actual real estate.
Brilliant. I just noted down the time. It's a 2-minute 25-second answer. Encapsulates everything that Mr. Sinha could bring into bear over the last 32, 33 years that he's been into equity markets. And forever I shall remember the difference between an asset which is presumed to be real estate and of course the stock price of a real estate company. These are two very, very different things. Let's address another part of the market, Sanjay ji, and that's got to do with the fact that you just mentioned that you make a lot of money when you go against the broader thought that is there in the market. And perhaps that one space is the very beaten down specialty chemical space, which possibly seems to be coming back after a 3-year hiatus. What are your thoughts on specialty chemicals, and are there any bargains to be made at this level within that space?
So, I agree with you that this space has been out of favor for quite some time, and that is not without reason, because the global prices were not supportive after the initial flurry that we saw close to COVID. But every commodity also has its own cycle, and in my opinion, the chemical cycle is now probably somewhere near the bottom. Having said that, you also need to keep an eye on what is happening at the company level. These companies in the last, you can say, pessimistic cycle have not shied away from investing in increasing capacity. And right now, if you see within the chemical sectors, the agrochemical sector looks like a near-term opportunity, because we are expecting a very good monsoon. We also see a lot of thrust on improving farm income. So three things I think are happening now in favor. One is that the cycle is somewhere near the bottom. Secondly, companies have invested in expanding capacity when the cycle was on a downturn. And thirdly, you now see the cycle turning upwards, and you are seeing within the 3, 4 subsectors within the chemicals, the agrochemical probably being the first one off the block. So having said all that, I think this is a good time to start looking at chemicals once again, because there is no doubt a disappointment that people have had with this sector for so long. But I think that disappointing time is now coming to an end.
Okay. Mr. Sinha, before I go ahead and ask you the next viewer question, I wanted to understand from you, we have talked about largely the sectors that you are positive on and where you feel value can be created even now. Where do you think are pockets of overheating emerging at this point in time? Where do you think it is time to stay away from after this recent rally?
Okay, so see that list, surely if you go look at the small cap and the micro cap space, that list is very long. In this particular space, I feel that much of the excessive valuation that you now see happening is probably got to do with some of these you can say the EPC and engineering companies. You I also see that there is certain amount of excessive valuation in some of these uh, telecom equipment suppliers. So therefore, sectorally, I think there are these pockets of froth which are building up, and it is probably going to be wise to be a little prudent in terms of picking up your picks from within these sectors.
Okay. The next question is actually a very interesting question. Of course, you will not tell us the stocks, but it's an interesting question, and therefore I put it across to you. From Mumbai, Ratnesh Kumar wants to know from you, which are the stocks that will be in focus with Tesla's entry into India? So,
Right.
are you with Tesla's entry into India? So, are you looking at Elon Musk's upcoming meet with Narendra Modi being some kind of an indication for all the investors at large? What kind of opportunities will emerge for an average retail investor?
So, people are expecting that the entire EV ecosystem will get fired with Teslas coming to India. What we are missing out in the process is that, we already have a very large two-wheeler EV sector within the country, and we also have now fair amount of EV passenger cars and CVs visible on the streets of Mumbai. So EDM companies, which are electronic design and manufacturing companies, companies which are into the battery space, they will obviously be beneficiaries in case Tesla is able to build a very large scale business very quickly in India. Otherwise, there is a fair amount of participation in that space by the existing incumbent players already. And therefore, it is not as if, India was waiting for Elon Musk to come and fire up our EV sector. We have already made a lot of progress there.
Okay, and that's fairly evident, at least in Delhi. If you see large parts of South Delhi, a lot of shopping malls, a lot of old world markets have already come up with the EV charging infrastructure, and I'm sure over the next 2 or 3 years this will also improve dramatically. In Delhi, at least, we don't have formal housing colonies, but in Gurgaon and Noida especially, because there are clear housing facilities, those facilities for charging cars are really coming up very quickly. Sanjay, you do a lot of stuff on the macro side as well. Given the strength of India's macro balance sheet, which is derived from how the banking sector has sort of shone over the last 3 years, gives a lot of comfort to global fund managers to bring in money. We are going to see the entry of sovereign bonds in the JP Morgan Global Index. How do you think that changes India's reputation and presence in the global bond markets? Is it going to be beneficial for the rupee? And what are the kind of inflows that you expect from this move 1 year from now?
So, see, there is one number which has already been touted, that the inflows because of the inclusion in the JP Morgan index would bring somewhere between 27 to 30 billion dollars. Over and above that, the inclusion in the Bloomberg index will also add some more strength to that number. But I guess what is these inclusions going to do is to make the Indian bond market increasingly visible to the global financial investor. I think if we have policy continuity, if we have stability in terms of regulations, you will see that this number is going to increase. It is up to us that we are able to create enough opportunity for this investment to be channelized properly. Because if we get into a situation where too much comes too soon, then that could create more imbalance than balance into the system. Having said that, to answer the other part of your question, the more inflows that we are able to attract by forex, and that inflow is of a stable nature, the more conducive will be the impact on our exchange rate. We have seen the rupee depreciate over the years, but on a longer term basis, if you see, given the fact that we are committed to move towards more renewable forms of energy, given the fact that we are aggressively promoting EV as a form of transportation, I think India's dependence on import of fossil fuels is going to come down, and that will itself bring down our requirement of forex. So on a longer term basis, I guess we anyway have a situation that rupee should slowly strengthen. On the near term, I guess the central bank has been reasonably benign in terms of allowing the rupee dollar to move in a particular band to sort of support our exports. But even in that background, we were probably one of the most stable currencies as per the statement of the RBI governor himself in the last 12 months. So on a secular basis, I guess rupee is going to be appreciating, but maybe not in a dramatic fashion. It will happen like a drop filling a pot where you will take, we will not even feel it, and the pot will be full.
Yeah.
Okay. Mr. Sinha, one question that I had was with respect to the Q4 earnings. What are you really looking out for in this sectoral earnings, as well as where do you see outperformance emerging from within the Q4 earnings?
So, see, autos could be one sector where you will see continuation of what we saw in Q3, because commodity prices continued to be benign, but the numbers were very strong in Q4. So that is one sector where you will see good numbers. Historically, the fourth quarter has been good for EPC companies. You will see some good numbers here also. And given the fact that the government finally loosened its purses and went ahead with disbursals in the fourth quarter, you will see good numbers from this sector. The pharma should deliver a very strong both year-on-year growth as well as quarter-on-quarter growth for companies, and more so for companies which are domestically exposed than companies which are more, you can say, export-oriented. So these are some of the prominent sectors where you will see good numbers. I think the quarter may not be very bad for even the FMCG companies, because for raw material prices, it has been a reasonably good quarter for them. And while the volume growth has not been spectacular, it has not been very anemic also. So this quarter overall, I think, should sort of add an icing on the cake of the last 3 quarters of a very strong earnings growth as far as the Indian corporate sector is concerned.
And on the front foot has TCS that has begun this icing on the cake. We have Infosys on Thursday and HDFC Bank on Friday. Let's see how these numbers are. Sanjay ji, we've kept the 2 most difficult questions for this fag end of the interview, and I'll start with the first one here. Where do you see the Nifty 1 year from now?
Well, difficult to put a number to that, but given the sort of optimism that we have, and this optimism, I take it that will be reflected in the macroeconomic growth over the next 3, 4, 5 years. Given the nature of the market, I think the rally will be more front-ended than back-ended, and therefore you might actually see maybe 60% of the rally in the first 2 years and maybe 40% in the remaining 3 years. So in that background, I will not be surprised if you see the Nifty anywhere between 28,000 to 30,000 points by December 25.
That's a wonderful, wonderful estimate, and I am sure all those customers and investors which Mr. Sinha is advising. And I'll just add one more line. A very well-known gentleman, Mr. M. Damodaran, who earlier headed US 64 and was also the chairman of the Securities and Exchange Board of India, has joined as a co-promoter at Citrus Advisors. So congratulations on that.
Thank you very much.
My final question, Sanjay ji, to you is there anything at all that keeps you awake at night? Any problems that the Indian markets might face? How will this bull market trip, if at all? And any word of caution that you would like to inject at current levels?
Okay, so on that count, let me give you the disclaimer that I fall off to sleep within 5 minutes of hitting the pillow. So
That's because you have that bungalow plot.
okay, okay, but there are certain risks that investors should be alive to, whether they sleep or not. One of them is that anything is attractive up to a particular valuation. Beyond a particular valuation, nothing can be justified. In the context of equity markets, what does it mean is that if you make a mistake in terms of price, you will have to pay the price in terms of time. You may have to carry an expensive stock in your portfolio for a very prolonged period of time, and the opportunity cost of carrying that in your portfolio could be expensive. So therefore, given the fact that markets being what they are, regardless of whatever we say, you will find that there will be some situations where money will start flowing to a particular part of the market. It has happened in the past. 1992, money started flying to all the stocks that Harshad Mehta favored. In 2000, 2001, money flew to IT stocks. In 2007, 2008, money had gone to the infrastructure sector. Today, we had a similar sort of thing beginning to develop when all the money was going to small and mid cap stocks. I think the regulator has done one good thing by raising an alarm bell, by at least making people realize that there is a lurking danger. So which is why I say that please put your money, if you are putting it directly into stock, there is no need for you to put into exotic sectors which you don't understand. It is always wise to put money into companies and sectors which you understand. And if you have more to invest, please give it to a professional to manage, who can do so either in a mutual fund or a PMS.
Okay. With that, ladies and gentlemen, this wonderful 45-50 minute chat draws to a close. Sanjay ji, so much we've learned from your wonderful explanation of how this bull market is unfolding in front of us. Thank you so much for all the good sectors that you've mentioned and the alarm bells that you have duly rung. We will keep all these data in mind, and we hope that we see you very soon along with Mr. Damodaran on Market Masters fairly shortly.
Thank you so much. Thank you for the opportunity.
Thank you, sir.
Okay. That, ladies and gentlemen, was Sanjay Sinha, founder at Citrus Advisors and one of the finest brains on the Dalal Street. Over the last 3 decades or so, he has navigated the bull and bear markets with equalities and created a long-term portfolio for his investors. I hope you enjoyed the show as much as Sakshi and I did, and please remain tuned to Business Today Television for all your needs as far as financial news is concerned at BTTV. Thank you so much for your time.
Thank you.
भाजपा के संकल्प पत्र का बहुत इंतजार रहता है और इसका एक बड़ा कारण है 10 वर्षों में भाजपा ने